Thanks for your company for the weekly this Friday, the 4th of December. I'm Jessica Amir, market analyst with Bell Direct. Well, what a cracking start to December, hey? Australia's economy officially snapped out of its first recession in 29 years, home loan applications rising to a brand new record high, and New South Wales heavily eased restrictions on Monday, lifting restrictions on weddings and funerals. The state government now allows up to 100 people at outdoor events, up to 5,000 at outdoor ticketed events, and up to 50 people on dance floors, and max capacity at stadiums and outdoor theatres. Next Monday, capacity will be doubled at restaurants, bars and cafes. Now, all these changes will further promote growth in some of these stagnating sectors of the New South Wales economy. Also this week, the UK became the first country to approve the Pfizer-BioNTech COVID vaccine for use and will commence its rollout next week. And the iron ore price gained over 6% to a 7-year high as Brazilian major Vale dropped its annual production guidance of the steelmaking ingredient. Now, this saw global rival Fortescue Metals shares rise to a brand new record high. Now, all this buoyed sentiment in the market Monday to Thursday. The benchmark index up 0.2%, still keeping it on pace to close off its fifth straight week of gains. The mining sector up the most, 5%, while investors continue to take profits in those defensive sectors like healthcare, which dropped 2% as CSL pulled back 3%. FMG shares up 11% to a brand new record high, $20.65 this week. That's as at Thursday's close. Rio popped 10% to an over-decade high. BHP up 7% to a yearly high. What's really key here, though, and to remember, is that Australian miners have been cutting costs of recent years, and earnings are larger from iron ore sales. Now, this year, the iron ore price is up about 51%. Iron ore demand is likely to continue to grow as China's producing 90 million tonnes of steel per month. In fact, iron ore is the key component of steel, making up 98%, and 50% of China's needs are met by Australia. Another consideration is that China wants to double the size of its economy over the next 15 years, so we'll need to build more property and infrastructure. So you'd think as long as China continues to source iron ore from Australia, earnings for the iron ore majors are likely to continue to grow, in particular for FMG, as it only produces iron ore. Other outperformers this week in the mining and industrial sectors included Sandfire Resources up 27%, Monadelphous and Oz Minerals up 11%. Food businesses also did well, like KFC operator Collins Foods up 11%, Domino's Pizza up 9%, benefiting from the most populated state, New South Wales, easing restrictions. Also of note this week, on Monday, we closed off the month of November. The ASX 200 gained 10%. That's its best monthly gain in history. The outperformers, the COVID hit underdogs, energy, banking, other financials, telcos and property stocks. These saw the most buying. Now, investment houses like Citi and Morgan Stanley say if you want outperformance, you need to take opportunities in these sectors, as well as in insurers and resources and engineering firms, as they're all likely to see earnings lift. Now, across the Atlantic in the US, stocks also closed off their best month in over 3 decades. The Dow and S&P 500 up 11%, the Nasdaq up 12%. But what stocks stood out in November on the ASX? Well, the worst performers this year, that's who. Unibol, Rodamco, Westfield up the most in November, 73%, followed by Webjet up 65% and Flight Centre up 52%. But moving to the big news item, Australia's economy blasted out of a recession. It grew 3.3% from July to September, stronger than the 2.6% forecast. Household spending up 8%. The biggest kick, a 10% lift in spending at hotels, cafes, restaurants, health and recreation clubs. Wages paid out also up 2.3%, with part-time employment up the most. The takeaway here, the economic V-shaped recovery is expected to continue. As in the September quarter, Victoria, remember, was still in stage 4 lockdowns, and New South Wales also had restrictions, and the government's budgetary support hadn't even kicked in yet. So support of $35 billion is expected to be forked out in the December quarter, so keep that in mind. Also, the RBA is forecasting Australia to have fully recovered from the economic downturn by the end of next year, given its forecasting growth of 5% in 2021 and 4% the year after. Now, Citi says Australia should be back at pre-pandemic levels by the first quarter of next year. This is well ahead of other nations' recoveries. So think about companies that are likely to benefit from increased consumer spending. And given restrictions have eased and household saving rates are at a record all-time high. So you could look at pub owners like ALE Property, Red Cape Hotel, casino operators like Crown, Sky City and Star Entertainment. Now, these are all about to enter bullish charting territory, so keep an eye on those. And funeral restrictions, given they've been scrapped, I'd look at InvoCare and Propel Funeral Partners, both the Bell Potter buys, and giving off bullish charting signals as well. And given the increased spending on individual transportation, I'd look at the car dealership business APE. Other businesses in the car industry I'd look at include GUD, ARB, Carbon Revolution, PWR. And finally, keep an eye on banking, property, travel, tourism stocks. Now, Bell Potter earmarked its favourite COVID-19 recovery stocks post the pandemic, and they include Aristocrat, ANZ, Macquarie, Flight Centre, Qantas, just to name a few. So there's plenty to consider for your portfolio. From all of us here at Bell Direct, have a happy and safe weekend. Bye for now.